Good evening, everyone. On behalf of Bangalore Valuers Association, I welcome you all to this session on taxation aspects relating to ESOP. Uh, Bangalore Valuers Association has a few vision statements. BVA shall be principle-centered and learning-oriented organization to promote quality service and excellence in the profession of valuation and shall be proactive to change. BVA shall harness talent of and disseminate knowledge to members, build skills and networks amongst them, and encourage them to adhere to the highest ethical standards and professional integrity. BVA shall provide to its members an environment conducive to the pursuit of knowledge, encourage them to achieve their potential to become competent valuers. With this, I request Shravan to introduce Uttam Padiwal.
Thank you, Chetan. First of all, thanks to Uttam for having accepted to be the speaker at a relatively short notice. Uttam, my dear friends, is a fellow member of the Institute of Chartered Accountants of India. He holds a bachelor's degree in commerce, which he secured with a rank from the University of Mysore. He is a registered valuer under the asset class SFA, and he also holds a diploma in international taxation awarded by ICI. His corporate experience includes working as a business analyst in a global business and technology consulting company. As a part of his employment, he has participated in overseas development and implementation of software projects. He's presently practicing under the name and style Padiwal and Associates, a consulting firm providing service in the field of accounting, finance, taxation, valuation, transaction advisory, assurance, and regulatory compliance support. He is presently running his own firm in the city of Mysore. With this brief introduction, I present Mr. Uttam to the session participants today. Over to you, Uttam.
Thanks, Shravan, for that. So basically, today we are here to discuss the taxation aspects of ESOPs. As part of the webinar series, we have already discussed the valuation of options, legal framework for ESOPs, reporting framework for ESOPs, and these sessions were conducted by luminaries. This is a huge shoes for me to step into. Let me try my level best to do justice for this opportunity. So to begin with, when we talk about ESOPs, especially the taxation aspects of ESOP, there are a lot of questions which comes to our mind. Whether ESOP expenditure is allowable as a deduction. If it is allowed as a deduction, what would be the timing of allowability of the deduction? Would it be at the time of grant? Would it be time of vesting? Would it be at time of exercise? Whether if it is allowed as a deduction, do we have to take into consideration the subsequent adjustments? What would be the impact of withholding of taxes? When it comes to the employee's perspective, would it be taxed as, would ESOP be taxed as a perquisite? Would it be taxed as a capital gains? There are a lot of questions which comes to our mind. So this is similar to a Rashomon effect. I mean, each one of us will be correct from our own perspective, but when we look at the entirety, we might be contradicting with each other. So the best thing to do would be to look into each aspect from various perspectives. So one of the perspectives which we will touch upon would be from the employer perspective. From an employee perspective, it's more or less simple and most of us might be able to appreciate the fact. But from an employer's perspective, there are a lot of issues which we will have to discuss. So let's go one by one. Let's try to understand what an ESOP would be from an employer's perspective. When we are saying that it's an employer, basically it's the company which would have allotted the ESOPs, which would have granted the ESOPs to its employees. When it grants the ESOPs, it will obviously grant these ESOPs at a discounted price. When we say discount, it would be the price at which the shares would have been quoted in the market, or the fair market value of the asset less the exercise price. So typically this is called as the discount. And finally, when the actual grants, when the ESOPs are exercised, the employer would be under the obligation to allot the shares to the employees. And when the employer allots these shares, there would be inflow of capital to the employer. So what would be the taxability of this inflow is what we'll be discussing in the coming slides. So first, talking about the discount. So when we're talking about the discount, uh, as we already mentioned, discount would be the difference between the market price at which the shares are quoted, or the fair market price at which the shares are valued, less the price at which the shares are allotted to the employees. So this is the discount which we are talking. Obviously, this discount would be computed on the sometime in the future, but then the deduction would be claimed at an earlier stage. So there is always a timing difference. And there is a timing difference. There is always the question as to whether this expenditure is an actual expenditure or a contingent expenditure. If it is an actual expenditure, what would be the value at which the deduction would be allowed? So there are a lot of questions. So this has always been debated, and there are a lot of judicial precedents which we can go through. There are precedents which have been which are in favor of the revenue, whereby it has been said that this is just a notional expenditure, and this notional expenditure need not be allowed as a deduction while computing the tax liability of the employer. Ranbacks is one of the cases where it has been held that it's a notional expenditure, should not be allowed as a discount. Similarly, there are other cases there are other judicial precedents which have said that these expenditures are allowable as a deduction. The highest level at which this has been disputed is at the Madras High Court. In the case of PVP Ventures, it has been held that the Madras High Court has held that the discount is allowable as a deduction. There are other cases also. Recently, the Delhi High Court, in the case of Lemon Tree, has said that this deduction is allowable. This discount is allowable as a deduction. Now, all these cases have drawn references to the special ITAT special bench of Bangalore in the case of Biocon, which was delivered in the year 2013. So in this case, the aspect of ESOP was dwelt upon in much detail, and the special bench has looked into many aspects of ESOP, and all the subsequent decisions have given reference to the special bench decision of Biocon. As of now, this Biocon case has been accepted at various levels. So the present day litigation is that the Supreme Court has given a special leave petition, and the special leave petition has not yet been heard. So as of now, the decision rendered by the Bangalore Special Bench Tribunal is the one which holds water. Let us basically look into the aspects in much detail. So as far as the judicial precedents are concerned, do we have any questions here?
Yeah, 1 second, Uttam. Do you have any slide on that? Because we are still seeing only is discount and expenditure.
No, the judicial precedents have not been provided in a slide. The reason being, it has not led to an ultimate decision. Therefore, it's always a debatable point. More or less, the Biocon case, the special bench decision in the Biocon case has settled the aspect. It's only for the Supreme Court to give sanctity to this decision, as well as probably some amendment to the Income Tax Act, which has not yet come. That's the reason we have not mentioned these points in the slides. Probably we can share these points as and when it comes up. Any other questions? Okay.
So what is the conclusion, like whether this is the expenditure is allowed or not allowed?
it is allowed as a deduction. The special bench has gone in great detail to explain as to why this discount is allowable as an expenditure, which will be touching upon in these slides. Yes, sir.
So, Uttam, just one question. So, what you're saying is, as of now, there's no Supreme Court ruling on the matter, right? It's only High Court, sir?
Yes, sir. It's only the High Court. At the High Courts, the discount has been allowed as a deduction.
Yeah, in any case, if a company is headquartered in Karnataka, they can very well claim it, right?
Yes,
because they'll be governed by the Karnataka High Court. Yeah.
Definitely. As far as the head office is located in Tamil Nadu, Madras High Court decision is there. In Delhi, there is an ITAT. There is an High Court ruling of Delhi. Delhi High Court has also given a ruling in this case.
So, and again, what he's telling is there are 3 High Courts, all of whom have ruled in favor of the expense being allowed. Correct?
2 High Courts, sir.
2 High Courts and 1 against.
Okay. No against decisions have come from the High Courts.
Okay.
ITAT, there are ITAT decisions which are against the SSC. Especially
that doesn't matter, no. If the High Court has given it, that will overrule it. Correct.
In fact, what has happened with in the case of Ranbaxy, as back as in year 2012, in the case of Ranbaxy, the Delhi tribunal had decided in favor of the department. It did not allow as a deduction, but in a subsequent ruling in 2018, in same ITAT, in the same ITAT, in the same Ranbaxy case, it has reversed the decision, but this is for a different assessment here.
Okay, fine.
Uttam, Srikanth here.
Yes, sir.
Yeah, Uttam, what are the premises on which this High Court agreed to consider this as a expense? You know, the bullet points on which they say that this discount is a allowable expense.
Very good question, sir. We'll be delving upon that point now, sir. So basically, all the High Courts have referred back to the special bench, ITAT Bangalore special bench decision. So the special bench has basically said that this discount is allowable as a deduction on certain grounds, which we'll be talking about now. The first thing is what was discussed was what is the primary objective of ESOP. So it was discussed and decided that the primary objective of allotment of ESOP is not raising of capital, but it is to provide an incentive to the employees to work towards the welfare of the entity. And also, since most of the ESOPs, the vesting condition is more so time dependent and not dependent on any other factors, mostly. So that will provide as an incentive to the employees to work for a longer period with the entity. So the purpose for which the ESOP was allotted was discussed, and it was decided that the purpose for allotment of ESOP is not capital raising, but as a motivation to the employees to work towards the welfare of the entity. In other words, it is a proxy for the remuneration which is provided to the employees. So this was the first condition, which was so whether it is a capital expenditure or whether it is a short deduction of capital expenditure was discussed, and it was found that it was decided that this is not a capital expenditure, this is not a short receipt of capital, but this is more so in the nature of compensation to the employees, and therefore this is a revenue expenditure. It was further discussed as to whether this expenditure is a contingent liability or an actual liability. The reason why this question of contingent liability was raised was because of the various timelines which are associated with ESOPs. As we all know, there are broadly 4 timelines which are associated with ESOP. First one is the granting of the ESOP, vesting of the ESOP, exercise of the ESOP, and finally the allotment of shares for those options which have been exercised. Now, when it comes to the granting of the ESOP, there are no liability which the company incurs. At this stage, no doubt the liability is a contingent liability. the liability will crystallize when the employees get the right to apply for the shares. In the ESOP terminology, this timeline is called as the vesting of the option. So when the option is vested, there is actually a liability which the company will bear. Therefore, the liability will crystallize at the time of vesting of the option. But although the liability will crystallize at the time of vesting of the option, the actual quantification will happen at the time of exercise of the option. Nevertheless, we'll talk about the quantification a bit later. At this stage, what was decided was this is not a contingent liability, but an actual liability, although the quantification is done on a reasonable basis, but not on actual basis. Now, the fact that this quantification is done on an actual basis, should we take into consideration any subsequent adjustment was also discussed, which we'll discuss at a later point of time. At this stage, what was decided was this is an expenditure because the purpose is not capital raising, but compensation to the employees. This is not a contingent liability, but an actual liability. The actual liability will arise at the time of vesting. On these grounds, it was held that the ESOP discount, the discount on issue of ESOP is a actual expenditure, and this is allowed as a deduction under Section 37. For those people who are not aware of Section 37, Section 37 is a general clause which says that any expenditure which is incurred for wholly and exclusively for the purpose of earning an income, for making of profits, will be allowed as a deduction, provided it is not in the nature of capital, provided it is not a personal expenditure. If it is not a personal expenditure, if it is not a capital expenditure, then it is allowable as a deduction under Section 37. So on these grounds, broadly on these bullet points, it was held that ESOP discount is an actual expenditure which is allowable as a deduction.
Uttam, sorry to interrupt. Just one more question.
Yes, sir.
Given this,
Yes.
Let us say in books of accounts, the expenditure amortized over the vesting period, correct?
Yes, sir.
So what is the amount that is allowed by the income tax authorities each year? The amount actually booked in the books of accounts as per the vesting period, or is it the entire amount?
We'll come to that, sir. In the subsequent slide, the quantification of the expenditure is what we will be discussing.
Okay. Okay. Thank you.
Any other questions, sir?
Presently, only merchant banker is allowed to issue this.
We will come to that also, madam. As to who is the competent person to do the valuation, we'll come to that.
So the flow of thinking is similar to that of provision for gratuity, right? The fact that it's an ascertained liability, it's revenue in nature.
Perfectly right. Perfectly right. The only difference between gratuity, so basically, as Shravan rightly pointed out, the flow of thought is similar to gratuity and leave encashment. In fact, the special bench also looked into the Supreme Court decision in the case of leave encashment, and it was held that this is similar to leave encashment and gratuity. The only point of distinction is with respect to gratuity and with respect to leave encashment, there is a specific provision which says that, provision 43B, which says that gratuity and leave encashment will be allowable as a deduction not on the basis of the books of accounts, but on the basis of actual payment. But no such provision, no such limiting condition exists in the case of ESOP. So that's the only point of distinction between gratuity, leave encashment, and ESOP.
Got it. Thanks.
Awesome.
And also maybe the fact that both leave encashment and gratuity are backed by laws passed by the Parliament of the country, whereas ESOP, it's not really any law that mandates, but it is at the company's discretion to grant.
Perfectly.
But it's good that in spite of this, the courts have allowed.
Perfectly right, sir.
Yeah, right.
So if you want to draw a parallel, it would be similar to provision for warranty claims. As Subraidu sir rightly pointed out, for warranty claims also there is no legal backing, but it is the norms which are followed by the entities. So similar to warranty claims, ESOP is also an actual liability and not a contingent liability, which is the quantification is done on an approximate basis, but not on an actual basis.
Okay.
Awesome. So now the two things which we have to look into is the timing of the ESOP and the timing of claiming of the deduction and quantification of the deduction. So in the ruling, what was also discussed as to what should be the timing of claiming of the deduction. As we discussed earlier, the timing would be at the time of vesting of the option. As and when the options are vested, we need to calculate as to what would be the liability for the company if these vested options are exercised. So the timing is vesting of the options, not exercise of the option. It is the vesting of the options. Now, when we compute the timing is vesting of the options. So as soon as the options are vested, that the liability pertaining to that vested option can be claimed as a deduction. How do we compute do the valuation? The valuation would be the fair market value at the time of exercise, less the exercise price, because the actual cost to the company would be the fair market value at the time of exercise, and the net cost would be fair market value at the time of exercise, less the exercise price. However,
Uttam, sir,
yes,
sorry to interrupt, because while you were on vesting, you moved on. I had a question on the vesting part only.
Yes, sir.
If the timing is that the deduction is given at the time of vesting,
Yes, sir.
okay, what is done about those options which are vested but not exercised? That would have to be written back in subsequent years.
Brilliant question. We'll come to this question. This is the last point, which this is the last part of this slide. Subsequent adjustments, which we'll be discussing in the next slide.
Okay.
So we actually, in an idealistic world, we should basically compute the fair market value at the time of exercise. However, at the time of vesting, the fair market value at the time of exercise will not be available. Therefore, as we discussed in the earlier slide, it's an ascertained liability. So this is the ascertainment which is done at this stage. The fair market value of at the time of exercise would not be available. Therefore, we make an estimate of the fair market value of at the time of exercise, and that is the estimate which will be claimed, which can be claimed as a deduction, subject to subsequent adjustments. What are those subsequent adjustments? We'll be discussing it in the next slide. As of now, it would be the estimated fair market value at the time of exercise, less the exercise price, which will be allowed as a deduction.
So at the time of vesting, do we need to get a merchant banker's valuation? Because otherwise, how will the assessing officer allow the claim?
Very good question, sir. So now, would we have to claim? Would we have to prepare a merchant banker's get the merchant banker's valuation report? Is a good question. Now, what would happen is, in most of the cases, see, basically when we discuss from an employee's perspective for computing the employee's tax liability, in any case, the employee would have to get the merchant banker valuation. So, and the income tax rules gives a 180-day period, 6 months period, roughly about 6 months period. Rule 3 talks about this 180 period. So a merchant banker valuation, even if it is 180, not more than 180 days old, would hold good. So ideally speaking, a merchant banker valuation will help us in defending ourselves. Having said that, if the valuation is done internally, or if the valuation is done by a registered valuer or by a chartered accountant or by any other authority, then it will also be taken into consideration. But if it is a merchant banker's valuation, it would be easier for us to defend. If it is an internal valuation, it would be a bit more difficult. If it is a valuation by a registered valuer or by an independent authority, then that independence can be, the fact of the independence can be flaunted, and thereby we can give a bit of more credibility when it comes to this estimation. Having said that, whatever estimate we do, if you prove that we take into consideration the subsequent adjustment, then that should hold good, Joy sir. Have I answered your question, Joy sir?
Yeah, thank you. Yes.
So the most important thing is at this stage we do the estimation, but we also need to take care of the subsequent adjustments.
So I have
to summarize your point, this entire thing, Uttam, the amount of expense allowed is the fair market value at the time of exercise less the exercise price. That is the amount allowable as a deduction. But the
Yes,
timing is at the time of vesting, correct?
Yes, sir. I would call it as the estimated fair market value at the time of exercise.
Yeah, correct. Correct.
So Uttam, I have another question not related to vesting part, but which is like I have seen a situation where there was an ESOP scheme by the company, but instead of issuing shares, the promoter shareholders said that they will transfer their own shares to the employees.
Okay, sir.
So whether in this situation, whether the company can claim a deduction?
So now, when the promoter actually gives the shares, it would not be called as an ESOP for the purpose of income tax. What I would consider it would be a secondary transfer. When it comes to a secondary transfer, in that case, what would happen is, if it is an unlisted shares, then we need to be mindful of section 50 CA as far as the transferor is concerned, and 56 to 10 as far as the transferee is concerned.
Correct. But the fact that the company has a ESOP scheme, that doesn't come into the picture at all.
I don't think so, sir. I am not aware of any judicial precedent on this matter, but from my yes, sir.
I had a client, and it's a client based out of Bangalore only,
okay,
which had this scheme.
Okay, sir.
And now I think by now they would have had some assessments done also, but
okay, sir.
Because the scheme is 5-6 years old now.
So now my question is, sir, how is the company involved? There are two parties. One is the promoter and the other would be the employee. How would the company interject between these two? Would there be a share? Would there be a? There would be a share purchase agreement as far as the employee and the promoter is concerned. How will the company interject?
So there is a tripartite agreement.
Okay.
And the company has to book the expense because that is the requirement of the accounting standards.
Okay.
So under accounting standards, even if the shareholder is giving the share, because the employee is rendering the service to the company,
okay,
the ESOP is, the company has to do a proper ESOP valuation like they do in other cases, and they have to account for that expense.
Awesome. So now, the special bench again, while giving the ruling on the Biocon case, has basically has also discussed as to whether the accounting standards or any other guidelines other than the income tax should be taken into consideration. So in that ruling, they have said that these cannot be, the income tax law cannot be subservient to any of these guidelines. In fact, the Challapalli Sugars case, all these cases have been discussed. But then what has been decided is any of the other provisions need not be given precedent over the Income Tax Act. Having said that, now when you are saying that in this case, the purpose is for, again, to motivate, if there is a tripartite agreement, then this tripartite agreement can be taken consideration, and accordingly this expense can be booked in the case of the company. And if that expense is booked in the case of the company can go ahead, in my humble opinion, the company can go ahead and claim a deduction, provided there is this tripartite agreement.
Yeah. So in this case, there's a formal ESOP policy which has been approved by the board and the shareholders, and there's a tripartite. So there's everything is in place.
Okay, sir. So
Uttam, just to interject here.
Yes, sir.
So whether there is a tripartite agreement or no, unless there is actual expense incurred by the company, it will not be allowed a deduction. So if it books an expense without there being any cash outflow, they will not get a deduction, correct?
Very
You
good
can't
point.
just take a
Very good
notional
point.
this thing.
Ve-
However,
very
if there is a cash outflow from the company, then the promoter may have to pay tax because he's got some consideration from the company. And then the company can book the expense. But without a cash outflow from the company, notional thing, especially if it's a second transfer, I don't think they'll get a deduction.
Oh, good question, sir. Now, this is a very good observation here as to whether there should be an actual cash flow. In fact, this point has also been discussed whether expenditure means expenditure which involves a cash outflow. Now, if we look into the Income Tax Act, there is no definition for expenditure. However, if I'm not wrong, Section 43, subsection 2 talks about various definitions. And in this definition, the word paid has been defined, and paid not only talks about cash outflow but incurrence of an expenditure. And there is another statute called as an Expenditure Act, whereby it has also been said that incurrence without a cash outflow is also an expenditure. So if we take into consideration the definition provided by Expenditure Act and also section 43 subsection 2, then we can conclude that expenditure need not necessarily involve a cash outflow.
Yeah, it can be an expenditure in kind. For example, if the company is issuing shares to the employee and thereby increasing its paid up capital, then it has given it in kind, and there is, for the purpose of ESOP, it can be considered as expenditure.
Yes,
but
sir.
in the case where the promoter is giving free to the company, basically is giving a gift to the company, or what is going on, we don't know. We'd have to see what the tripartite agreement is, but there is no consideration there. If a company has increased its share capital to give it to the employee, there is a consideration because you and your share capital is increased, your liability is increased.
Correct, sir.
So
now here, it's again a very good point, sir. Now, would that be considered as a gift? Even if it is considered as a gift for a moment, it will not be taxed under section 56.2.10 because this particular 56.2.10 will only cover certain assets, and I don't think these what we are discussing now will come under certain assets. So
I'm not going there. I'm just
so if I can come in, the structure is that whenever there's an ESOP scheme of the company, and the promoter basically under that scheme is required to actually part out his shares. Let us say if it's a 7.5% scheme of the company where promoters to the extent of 7.5% of their own capital have to give it as an ESOP, then this is how it works. And that is in sync with both the accounting standard and the Income Tax Act. And this is what we do actually, everybody does. Effectively, what happens is that the fair market value on the exercise date is, let's say, 10 rupees. The exercise price, let us say, is 5 rupees. The difference between the fair market value and the exercise price is paid by the company to the promoter.
Okay.
The promoter per se basically has a tax of capital gains that is there between the fair market price that he gets and the price that he has incurred. That is paid by him in his own hands, and
that's right.
The CA is obviated. Therefore, the cost actually is to be incurred in the books of accounts on a cash basis. And the cash has to be paid by the company, and that is an expense. So it is not an imputed cost, and nor is it basically a notional cost in the company. It is a cash cost, and therefore it is actually an expense in the hands of the company, being the difference between the fair market value on the exercise date and the exercise price per se. And
that makes sense.
Value then basically goes as a consideration to the promoter because the exercise price comes from the employee. The difference between the exercise price and the fair market comes from the company. That is the gain to the promoter, and the promoter then pays his taxes according to that.
Awesome.
The structure, and this is both in sync with the accounting standards, guidance note, as also with the Income Tax Act, and there's no play of section 56.10 coming into 56.2.10 coming into play, or 50 ACE.
So in my case, there was no cash being paid out by the company. That is the only difference.
So the cash, if there's no cash being paid by the company and there was still a difference of FMV to the exercise value, in that eventuality, 56,210 will come into play because it is a shortfall in cash consideration. And therefore, the company will be responsible to pay the tax liability.
No, that would be the shareholder or the company. Who?
Both, sir. I mean,
So it will be shareholder and the employee. So
it will be a double whammy because in that eventuality, 56,210 will also come into play and 50 CA will come into play, both. So effectively, I think it's a bad scheme if there's no cash being transferred, because that is so the case, and there's a difference between the FMV and the exercise price, the FMV being greater. It will be a double whammy in terms of 56,210 as also in 50.
In this case, the employee will be getting a benefit of 5 rupees. He'll be only paying 5 rupees. So the perquisite value tax needs to be paid by the company here. Though there will be
no, sir. Here, in my opinion, it would not be taxed as perquisite, but it would be taxed as income from other sources, because the employee is getting the shares of an unlisted. We are presuming that the entire discussion is revolving around unlisted companies.
Yeah,
so,
it is unlisted company.
Yeah, so the employee would be receiving a 10 rupee share for 5 rupee because that's the exercise price. So, in which case, the balance 5 rupees would be the amount which the employee might have to pay. Now, for having said that, for computing the fair market value, there is a specific code which is given. So, we will not be worried about whether it's the code which is provided, whether it's a merchant banker valuation or not. Here, we'll be only guided by the code which has been provided by Rule 11 UA.
correct, sir. But then promoter is already paying tax on the consideration received by the employee and the consideration received by the company. So that is equivalent to fair market value. That is his sale price, sale consideration.
Yes, sir.
The cost that he has acquired, the capital gains computation will go in place, and he would have discharged the complete taxation, and promoter discharged the complete tax at that point in time.
Yes,
but
sir.
there is again second point of taxation when it comes to the in the hands of employee who is receiving the benefit of 5 rupees again. So there is double incidence is what I am able to gauge based on the discussion that are prevailing in the past 5-10 minutes.
Awesome. As far as I know, in this case, this might not be taxed as a perquisite in the hands of the employee.
Irrespective of the incidence, perquisite or as the salary, or if it is not perquisite or under income from other sources, it is taxed. So when it is a double incidence is what I am going to tell.
Yes. There might be double incidence. So as Adarsh sir mentioned, this might not be a tax efficient structure.
Yeah.
Okay.
Any other questions at this stage, or shall we move forward?
Uttamji, Hari Surya here.
Sir.
Yeah, maybe I think this is not a correct structure. Promoter can directly transfer to the shares to the employees. Maybe he can transfer to the trust. Okay. Anyway, Companies Act allowed. Company can give a loan to the trust. Okay. Trust will buy the shares from the secondary market. Maybe listed or unlisted is a different matter. Okay. Then this secondary market trust will buy the shares from the promoter. Then problem will be solved.
Here too, when the trust purchases the shares from the promoter,
not promote secondary market, maybe promoter, maybe other shareholders also. There will not be no differentiation.
So if it is listed company, it should not be an issue. If it's an unlisted company and if the trust is buying the shares, is procuring the shares from the secondary market, again the fair market value question might arise. But let me tell you here, the fair market value is as per the is a variant of the net book value method. Is a variant of the net book value method.
Correct, sir. See, I am not talking about the valuation. For the expenditure booking point of view, it will be company side also. It will be very much easier to book the expenditure and other things also. See, anyway, we have to do the fair market value because it is unquoted share, obviously.
Yes, sir. Yes, sir. This can again be deliberated upon. Probably, I mean, we can take it offline, or probably we can follow it up with another session whenever time permits. Would that be fine?
Thank you.
Awesome. So nice of you. Thanks a lot for all your inputs, gentlemen. So now, in the previous slide, we said that we will compute the, what would be the cost would be the estimated fair market value is what we said, subject to subsequent adjustments. Now, as Subrayadu sir rightly raised a question as to what would happen to those options which got vested but never got exercised, or which never got exercised. So now, again, this was discussed in the ruling, and what the special bench arrived at, what decision the special bench arrived at was, subsequently, if there are any lapses, if there are any options which lapse, whatever is the deduction which was claimed earlier should be adjusted downward. So that will be that expenditure will be added back to the income in the year in which the options lapse. This is one downward adjustment which happens. Again, as we said, at the time of vesting, we make an estimate of the fair market value. At the time of exercise, we have the actual exercise price. So here too, there might be a variation between the estimated fair market value at the time of vesting and the actual fair market value. If there is any difference, then this difference also has to be adjusted. This difference can be an upward adjustment, or it might be a downward adjustment as well. To just give you an example, let's presume at the time of vesting, the estimated fair market value was considered to be 100, but at the time of exercise, the actual fair market value was 110. So there is an additional cost. This additional cost can be claimed as a deduction in the year in which the option is exercised. If there is a downward, on the other hand, if at the time of exercise of the option, if the fair market value is 90 rupees, then whatever 10 rupees excess deduction was claimed in the earlier year has to be added back. So these are the two kinds of adjustment which needs to be made. Does that answer your question, Subrayadu sir?
Absolutely. Thank you very much.
Any other questions as far as the adjustment is concerned? Okay. So we have talked about the initial claiming of deduction. We also have talked about the subsequent adjustment. Now, so this should more or less finalize our discussion on whether the discount on ESOP can be claimed as an expenditure. If yes, at what time? If it is done on an estimate basis, then should we take into consideration the subsequent adjustments? Now, let's talk about the other important aspect of withholding. Now, when the option is exercised, it becomes an income to the employee. At that point of time, the withholding provisions will get attracted. Section 192 of the withholding provisions will get attracted. So at that point of time, the employer is bound to deduct tax from the employee's income. Now, please note that when an option is exercised, the employee will not get any cash payout unless it is a SAR. Considering that in ESOP, he will not get any cash payout. He will not get any cash inflow. But there will be an additional burden on the employee because the employer will deduct tax from the other salary. Therefore, the net take-home salary of the employee will come down. If there is no deduction, if there is no withholding which is made by the employer, then whatever deduction he had claimed in the earlier years will have 30% of that expenditure will be disallowed under Section 40A. This is one thing which he has to be mindful of. So this is something which has to be put forth to the employee beforehand, before he exercises the option. So we will have to take the employee under confidence when he exercises the option. An alternate to do this is, instead of deducting the tax, if the employer is willing, then he can bear the tax burden, what we call it as grossing up. Under Section 192 subsection 1A, grossing up of the taxes is allowed. The employer can bear the burden of this ESOP tax on the employee. When he bears the burden, then there will not be any withholding. this burden which the employer takes on his head will not be an additional income in the hands of the employee, because this additional burden which the employer takes is exempt from tax. However, the only problem with this arrangement is that the additional burden which the employer takes will not be allowed as a deduction while computing the employer's tax. So this is as far as the withholding of tax is concerned. One small point here: if the employee is a non-resident, then there is no withholding which will be required, because as far as an employee is, as far as withholding for non-resident is concerned, salary is not part of the withholding code. Not part of the deduction code. Disallowance code. It will not part of the disallowance code. However, disallowance will not be there, but all the other penal consequences of non-deduction of tax would be applicable on the employer. This is as far as the withholding of tax is concerned. Any questions at this stage?
So the grossing up will be an actual grossing up in the sense that, for example, if the perquisite value is 100 and the tax rate is 30, so 100 will be treated as 70%, right? And the tax will come to 42 rupees or 43 rupees or whatever.
Yes, sir. You are right, sir.
So that will be the grossing up. It
Yes,
will not
sir.
be just. It will not be just 30% of 100.
No, it will not be 30% of 100.
So it will be.
Yeah.
So the tax incidence will be much higher on the employer.
Yes, sir. Yes, sir.
In case of startup companies where the recently in budget there's some provisions are made that for case of startup or at the time of vesting or 5 years, whichever is will be the earlier later, the employee has to pay the tax.
Yes,
So
sir. We'll come to that. That's an exception which has been provided for in the recently concluded in the 2020 budget, in the basically 2020 Finance Act. There have been certain changes which have been made, but as of now, that's an exceptional rule. We'll come to that exceptional rule.
So my point was here. Please explain withholding provisions at same point of time, how it will be applicable to them.
In the case of startups, we'll come to that at the end when we are talking about the exception. Would that be fine?
Yeah, definitely.
Yeah.
Okay.
So startup is one thing which I have deferred for the end. Yeah. Any other questions?
Uttam, maybe not related, so sorry, but because this is relevant, I thought it was relevant to bring up. So what we're looking at is, as far as tax allowable expense is concerned, this is the estimated fair market value minus the exercise price, which is the allowed expense.
Yes, sir.
As far as books is concerned, this is the fair value of the option on the date of grant less the exercise price, which is the expense.
Perfect, sir.
Correct. So which
Perfect,
means the tax expense and the book expense, there's going to be a permanent difference. Right? There's not a timing difference, correct?
Yes, sir. You are right, sir. I mean, until we are able to close the entire option scheme, we will not be able to say whether it's a permanent difference or a timing difference, because there will be subsequent adjustments also, because what we are estimating now is
agreed. But you'll have to do this every year on an ongoing basis, correct?
Yes, sir. Yes,
so
sir.
Every year, if you're doing it for one particular year, for that year, there is a permanent difference.
Yes, sir. Yes, sir. I would not call it as a permanent difference until the ESOP plan is closed, or if the ESOP is exercised, because there will be subsequent differences. So I will defer it. I will defer the judgment as to whether it's a timing difference or a permanent difference until the ESOP is exercised or let to lapse. At that point of time, I will take a decision as to whether it is a permanent difference or a timing difference.
But what is the...
So the point is that anyway, the whole amount is not a permanent difference. Now, it will only be the difference between the fair value of the option and the FMV on the exercise price.
Yes, sir.
So
yes,
only
sir.
that portion will be permanent. The rest of it will anyway be timing difference.
Yes,
So,
sir.
but why are you calling it permanent if it will be trued up at some point of time, or is there something which will never be?
I'm calling it permanent because conceptually there is no further room for it getting trued up. If a difference is 5 rupees today, okay, there is only one small difference, that just in case the fair market value as on the actual exercise date changes somewhat, Barring that, there's no other trigger for this difference to be squared up. Correct?
The other trigger, would be this, sir. Other trigger would be the lapse.
Okay.
If there is a lapse. So these are two. So that's the reason
yeah,
I would
okay,
let it differ. I would let the decision as to whether it's a permanent difference or a timing difference. It will be. I would call it as a timing difference until the option is exercised or lapsed. After at that point of time, I will take a decision as to whether it's a permanent difference or a timing difference.
Okay, so let me kind of change the question slightly. Let us say the actual exercise has happened.
Okay, sir. Okay, sir.
By the time whatever is the difference is existing, that difference must be a permanent difference. Correct?
Perfectly right, sir. Perfectly right. Perfectly right. Perfectly right. Okay. So okay. Now, again, I mean, my sincere request is basically, I mean, it would be a very good idea to go through this special bench ruling. We will share this special bench ruling also, because it has gone in great detail in explaining as to what would be the implications of ESOPs. It's a beautiful decision, which for any person who has a flair for taxation, my sincere request is he has to go through this ruling. Now, the only issue about this ruling, or the one of the observations here, was that the ruling was an awesome ruling, but then there was no finality which was reached at the ruling. The irony is, the special bench asked the AO to relook into the matters because the amounts were not available at the with the special bench. So it said that as far as the amounts are concerned, please relook into the matter. So now, in order to achieve certainty, we suggest that this is the kind of records which would be suggested. If we keep, we will have all the if we keep these records, then we will have all the matters at the tip of our hands as far as the ESOPs are concerned. So what amount has to be claimed as a deduction on a year-to-year basis, what amount has to be adjusted on a year-to basis, everything would be captured if in an Excel sheet or in any matter which contains minimum of these amounts. Any other further details will add to the clarity, but this is the minimum requirements which we suggest our employees to keep. And I mean, this has not been tested by the assessing officer as of now, but these are the records which we have suggested our clients to keep, and they have had a lot of clarity explaining it to the statutory auditors, explaining to the consultants who prepare who advise on the tax matters. So this is the minimum details which is maintained, especially subsequent adjustment, notation number N, notation number G, and G, H, and M. These are the G, H, M, and N. These are the 4 important records if we keep, that will help us deal with any matters as far as the claiming deduction is concerned. So this is more or less as far as the employer is concerned. So these are the we have discussed what would be the tax implication on employer is concerned. Now we will take out the employer hat and will come to the from an employee's perspective.
Uttam, one question,
sir,
before that.
Sir.
So before we go to the employee part,
sir,
for clarity, could you link up the valuation which is done by, let's say one of us gets an opportunity to value ESOPs, how will that go into the cost, and where in the valuation what you're doing for the fair market value and so on, what is the link between that valuation, the fair market value which is taken as a deduction, the difference I'm talking about, and then the tax deductibility. The tax deductibility we have understood, but from the valuation of the ESOP to what the company books in its accounts, could you just give that link?
Sir, so what would happen there is, in my opinion, what would happen there is when a ESOP valuation is done for meeting the requirement of either the guidance note or the Ind AS by an independent party. See, basically, when we are claiming the deduction, we are doing it on an estimated basis. So the valuation which is done by either internally or to meet with the accounting standards requirement, Ind AS requirement or the guidance note, that can be taken into consideration provided there are subsequent adjustments which are made. Since this valuation is done by an independent authority, that will add more credibility to the estimation. So that is where, if it is done by an independent party, we are not debating as to whether it has to be done by a registered valuer or not. If it is done by an independent authority, then when it comes to assessment, it will add more credibility.
Okay, let me put the question this way. I'm just trying to quantify it. Let's say the exercise price is 50 rupees.
Okay, sir.
Okay. Now, we don't know what the fair market value will be 2 years hence, whatever the date is.
Yes, sir.
But we know all the other volatility, etc., etc. We calculate the ESOP value.
Correct.
How is that going to be booked into the accounts, and what is going to be claimed as deduction?
Okay. As far as the tax accounts are concerned, as far as the books of accounts are concerned, since we are complying with the guidance note and or Ind AS, that would be fine. As far as the tax books are concerned, as far as the tax computation is concerned, and we have to be mindful of the fact that there is no ICDS, income tax computation and disclosure standards, as far as this is concerned. So as far as these two are concerned, if the exercise price has been estimated to be 50 rupees and that option has been vested, but
not estimated, it's given.
We have computed. No,
not computed. The company is saying you will get these shares after 2 years at 50 rupees.
Awesome. So exercise price is actual, but we estimate the fair market value, and accordingly we make a provisioning in the books of accounts after deducting that 50 rupees.
So am I right in understanding that the first accounting entry for the cost will be based on the valuation done of the ESOPs?
Perfectly right. Perfectly
right. So if I may add here, so because our cost will go into the books in respective years depending on the period of vesting. Correct. So it will go on a proportionate basis. So in those respective years, we have to disallow it for tax purposes.
Yes, sir. Yes, sir.
Then in the year in which they vest, then on that year, on the basis of FMV, we calculate a new number, and that is claimed as a deduction.
Yes, and which is further tested in the subsequent years depending upon these two conditions.
Correct.
So and just on the valuation, a little bit, won't take more than a minute. So normally we calculate the value of the ESOP, right?
Yes.
Let us say the strike price is the exercise price of 50, and the value of the stock is already 75. Okay. Then but all the same, I suppose that will also be included in when we do the valuation of the ESOP, that will also be as a factor that will be considered, correct?
We will do the valuation of the ESOP for, as far as the books of accounts are concerned, we will do the evaluation as provided by the either the guidance note or the accounting Ind AS.
Okay.
We'll follow the same.
I'll just if I understood the question right, there are two things. One is option valuation, the other is share valuation. We are doing the share valuation, and only share valuation is important to arrive at the cost that the company has to book, right? Option valuation, like Uttam is saying, is only in relation to booking, from an accounting angle, either Ind AS or non-Ind AS. Is that right? Option valuation amount is not considered for calculating the cost as per income tax, right?
No.
It's only the share valuation.
You
because
are
we are
right.
talking about fair market value of shares.
Correct.
minus the exercise price, and nowhere we are talking about the option valuation. So the ESOP option valuation as such is not at all considered in this entire income tax scenario, right?
Yes, yes, you are right.
Yeah,
you are right.
So that was the genesis for this entire permanent difference or whatever we were discussing a short while ago. Yeah.
Perfect.
So
Perfect.
basically it is the intrinsic value which gets considered. So intrinsic value on the vesting date and intrinsic value on the exercise date. Those are the two considered for tax purposes. Whether we take intrinsic value or whether we take fair value of options on the grant date, that is to be disallowed for tax purposes.
Yes, sir. Yes, sir.
Yeah, disallowed. That will be disallowed. But okay, the original entry, booking, and all that will be on the basis of that.
Yes, sir. Yes, sir. For the booking of expenditure, we do the option valuation. As Shravan rightly pointed out, we do the option valuation that can be reused as far as claiming the deduction is concerned, provided we do the subsequent adjustments.
Uttam, as on the balance sheet date, assuming the lock-in period under the ESOP plan is not yet expired, that is the vesting as on the balance sheet date has not yet started, then the company absolutely books zero cost, right? I mean, there is nothing to be booked at all.
Correct.
Okay.
Correct.
No, just want to clarify.
Correct.
No. Why?
For taxes.
For
income
taxes, yes.
Taxes. Yes, for income tax.
Yes.
For accounting under accrual, it will book.
Yes.
Yeah,
so basically, to paraphrase Shravan, nothing can be claimed as a deduction. Booking is not the question. Nothing can be claimed as a deduction. If there are...
correct. Yeah. I think when we're talking about income tax, claim is a better word because we've been using booking many times. So, yeah.
You're right. You're right. I mean, this is as far as the employer is concerned. Now coming to the employee, it's straightforward. I mean, most of this should be clear to each one of us. But still, let's run through. Run through the motions. One is basically, as I said, there are four levels as far as the ESOP is concerned. One would be the grant of the ESOP. Second would be the vesting of the ESOP. Third one would be the exercise of the ESOP. Fourth one would be the sale of the shares which were allotted. So at the time of granting, there is no income which is constituted to accrue to the employee. At the time of vesting also, no income is the employee does not get any income. But when it comes to exercise, there is an income which is deemed to accrue to the SSC, to the employee, which will be taxed. We'll see how it will be taxed a bit later. Now, when shares are at the time after the exercise is done, shares will be allotted at the exercise price to the employee. And once these shares are held by the employee, he subsequently sells, and when he sells, capital gains will arise. So, so as far as tax implication is concerned, at the time of grant, there is no tax implication. At the time of vesting, again, there is no tax implication. At the time of exercise of the option, there will be a tax liability. It will be taxed as perquisite. Please note, as we already discussed, at the time of exercise of the option, not only would there be a income which will be constituted, but also there will be tax withholding provisions which will get attracted, subject to startup valuation, which will come which we will discuss a bit later. Finally, when the shares are actually sold by the employee, there will be capital gains tax on the employee. Now, how do we do the valuation of perspective? Now, we are not talking about the employer at all. We are only talking from an employee's perspective. When it comes to an employee, when he exercises the option, as we earlier said, there will be an income which will be considered to accrue to the employee. The amount of the quantum of income would be fair market value at the time of exercise, less the exercise price. Now, what is the fair market value? In the case of if the shares of the companies are listed, then the fair market value shall be the closing price of the share in any recognized stock exchange, which records the highest volume of trade in such share on the date closest to the date of the exercise. So if the exercise, if we have the date, if the shares are traded on the date of exercise, we'll take that date. If the shares are not traded, then we take the nearest date. And if the shares are traded in multiple stock exchanges, we will consider the closing price of that stock exchange where the highest amount of trading has happened, highest volume of trading has happened. This is as far as the valuation of the this is as far as valuation of listed shares.
So, Uttam,
Yes.
just one clarification. As far as I understand, here we will not see whether the share is frequently traded or infrequently traded.
No.
So, like in SEBI, we look at that. Here we will not look at that. Here we will simply see which stock exchange has the highest trading, and we will simply take that price.
Yes, sir.
Irrespective
Yes.
of whether it is frequently traded or infrequently traded.
Yes, sir. I have not come across a case where this has been disputed. I have not come across a case where this has been disputed. Probably the logic is that the market itself will do the price discovery.
Sorry, Uttam ji, Hari Surya here. Joy ji, what Joy Jain is telling is correct. See, in the present scenario, there is a definition called frequently and infrequently traded shares. Okay, even if it is company is listed, but it is sometimes it is very thinly traded. Every 2 months, every 4 months, every 5 months. Generally, for the namesake, some some traders are happening in the stock exchange. So what Joy ji ka point kya hai ki no need to consider the frequently and infrequently definition. Whatever closest price, suppose today is the excess date. Today no traded happened. Then you have to go by closest date. Closest date maybe 1 day, second day, 1 month, even 2 months also.
Yes, sir. Yes, sir.
Yes.
Yes, perfectly. And there is no concept of frequently traded, infrequently traded as far as this taxation provisions are concerned.
Correct, sir. Thank you. Yes.
Awesome. Awesome. Now, coming to the unlisted shares, if the shares are unlisted, then the fair market value has to be computed by a category 1 merchant banker, and there are no other valuers which are recognized here. And it need not be the valuation need not be obtained on the date of the exercise alone. It can be any valuation which is not more than 180 days from the exercise date. So, Shilpa madam, as far as your question is concerned as to who can do the valuation, does that answer your question? The answer is that it has to be done only by a category 1 merchant banker.
Yeah, but I have one more doubt. Suppose this exercise date may not be a fixed date. So each employee, say, window is given, say, 1 month for exercising. Each employee may take a particular date. So exercise date, will it be different for each employee?
Yes, for each employee, the exercise date would be different. However, that's the reason why this 180 days period probably has been given. However, he need not go to the extent of getting the exercise price the valuation done on each date. So, I mean, roughly speaking, 2 valuations in a year from a merchant banker should cover all the exercise dates. Okay. Now, having said that, I don't know. I mean, I have not tested this, but there is a very old case from wealth tax where it has been said that if it is not possible for us to get the valuation done on the transaction date, then we can consider the latest audited balance sheet. There is one valuation, there is one judicial precedent, not under the Income Tax Act, but under the Wealth Tax Act. I don't know whether we can use it if there are no valuations from a merchant banker, not only for the excise date, but also even if it is not available for the last 180 days, probably this might be used. I have not used it though. So this is as far as the valuation of the perquisite is concerned. Any questions? Any questions on the valuation of the perquisite? So now, sir, we have not yet touched upon the startup. So this is startup is a exception. This is the general rule. We'll discuss the exception a bit later.
So I would just like to add one point from a valuation perspective purely. Is that sometimes the companies get merchant banker valuations for other purposes, say for FEMA or something else. So we need to see what was the purpose of that valuation, because the valuation for different purposes can be very different. So say if there is a valuation for the purpose of FDI, that valuation may not be relevant for the purposes of ESOP, because for an employee, as far as the employee is concerned, employee is a minority shareholder. There is for an unlisted share, there is a lack of marketability. So all those factors have to be considered to arrive at fair market value for for a share being held by an employee versus that for an FDI or some other purpose?
So, I mean, the only difference, very good point, sir. I mean, I completely agree with you, Joy, sir. The only point of distinction might be the DLOC, discount or premium for lack of control or for gaining control. That might be the only adjustment. Apart from that, I mean, for this particular purpose, I don't see any difference. But having said that, yes, purpose for that matter, purpose of any valuation report has to be considered before we jump into the conclusion.
Right. That's right.
Awesome.
So in that case, can we use the same merchant bankers report for ESOP also, like for FMB calculation?
Okay. Now, Joy sir, correct me if I'm wrong. What we need to do is, I mean, if there is a valuation which has been provided for a merchant banker, by a merchant banker for a FDI purpose, so we need to see whether there is any discount given for lack of control. Whether the foreign investor is also a minority shareholder, and if the foreign investor is a minority shareholder and so is the Indian investor, so is the employee, then I think we can use that valuation report.
So my only comment is that many times what will happen is that it will lead to a higher valuation, and you are unnecessarily paying higher tax on the perquisite value for the employee.
Correct. You're right, sir.
Yeah, right. Just you may have to consider that even though the foreign investor might also be minority, but he could be getting a 10% to 15% stake. This guy would be taking only a couple of hundred shares, and for 10-15% share, he might also be getting certain things like a seat on the board or something like that. Right.
Sir, for this, I mean, whenever we are considering, I mean, in my humble opinion, when we are doing the valuation, we should consider the other factors, as you rightly pointed out. The other factors have to be definitely taken into consideration. If there is a board seat, all these things have to be taken into consideration when we are doing the valuation, in my opinion. However, having said that, it's easier to tell, but how do we quantify it is the biggest question. I have not been able to find an answer for this. So, I mean, I look
at... Agreed.
Yeah.
Uttam, sorry to interrupt. I think we are running short of time. There will be 15 minutes more left. So,
awesome. So the next point is, I mean, we'll quickly run through the from an employee perspective. Now, at the time of exercise, it was taxed as a perquisite. Now the employee has exercised the option. He has been allotted. He has paid the exercise price. He has got the shares. He has got the shares have been allotted to him. Now he sells these shares. When he sells these shares, what would be taxed would be the capital gains, and what would be this would be a capital gains. Nature of this income would be capital gains. What would be taxed is sale consideration, the price at which the employee is selling, less the perquisite value. Now here, the sale consideration in the case of unlisted company shall be the higher of the net breakup value or the actual sale consideration. So this net breakup value is nothing but the code which has been provided in Rule 11 UA. This is one point which we wanted to make. Now, as far as the period of holding is concerned, it would be the period of holding for determining whether the sold shares are long-term or short-term. The period which should be taken into consideration would be from the date of allotment up to the date of transfer. Having said that, there is also this grandfathering concept which has been provided on section 55, read with rule section 112. So grandfathering provision will also be applicable in the case of listed shares if those shares were allotted on or before 31st of January 2018. And what would be the amount of tax? If the shares were held for, if the period of holding is more than 24 months in the case of, I think I have, there's a typo here. In the case of listed shares, it would be considered as a long-term capital asset if it is held for more than 12 months. In the case of unlisted shares, it would be considered as a long-term capital asset if it is held for more than 24 months. I mean, it's a typo error. I mean, I'll make this before I circulate this presentation. I'll make this change. I apologize for this typo. We'll make this change and circulate this. So just to reiterate, in the case of listed shares, If the shares were held for more than 12 months, then it will be considered as a long-term asset. If it is held for less than 12 months, it will be considered as a short-term asset. In the case of unlisted shares, the period of holding would be 24 months is the period for which would determine whether it's a long-term asset or a short-term asset. Having said that, the rate of tax is, if the asset is a listed share and if it is a short-term capital asset, then the rate of tax would be 15%. If it's a listed share and if it's a short-term asset, then the normal tax rates would then the rate of tax would be 10%, and there will not be any indexation benefit. Capital gains will also be applicable only if the total capital is the sum total of all the capital gains is more than 1 lakh rupees arising from all the sales of listed shares which happened during that year. In the case of unlisted shares, if it's a short term, then the normal tax rates will apply. In other words, it will be added to this slab rate. In the case of long term unlisted shares, it would be 20% with indexation benefit. In the case of unlisted shares, where the period of holding is 24 months.
Uttamji, Hari Surya here. Could you go back the previous slide, please? Just 1 second, only one moment.
No problem, no problem, sir.
Sir, here difference between sale consideration and perquisite value, or sale consideration and FMV on the excise date is the capital gain difference?
Perquisite value would be the FMV, no sir. Perquisite value is nothing but the FMV. FMV minus the exercise price. We need to take into consideration the exercise price as well. So perquisite value here means FMV minus the exercise price.
No, but since the exercise price is also paid by the employee, sir, so here it should actually be FMV.
Sir, that's why I also
perquisite value plus exercise price is equal to FMV.
Otherwise he will attract higher capital gain. Otherwise again.
Agreed.
Yeah, it's a
Agreed.
Yes, sir. Thank you.
My apologies. Thanks a lot, Hari sir. Thanks a lot for that. I'll make this 2 typos. I completely got a bit.
Just one more small nuance here. So what he said is, for the holding period of determining whether it is short term or long term, the period considered is between allotment date, correct?
Date of allotment. That is right, sir. That is right.
Whereas vesting date could be something else. And normally allotment may happen after vesting, because allotment might need a board meeting or something like that, correct?
Correct, sir. Correct, sir.
So for the time that is elapsed between the vesting period and the allotment period,
unfortunately, the benefit is not available. So for the period of holding will be constituted from the date of allotment and not from the date of exercise or from the date of vesting. It would be.
Whereas if between
I think Mr. Subarayudu meant actually exercise date, because vesting date and exercise date could also be very different.
You're right.
Yes, sir.
Exercise date.
So if there is a time lag between the exercise date and the allotment date, the period for which the employee that period will be lost for as far as the employee is concerned.
Yeah. Okay. But as far as taxability is concerned, the entire difference has to be paid.
Yes, sir.
Gain will be from exercise date till the sale date.
From the yes, you're right. Yeah, you're right. You're right.
Yeah.
So I mean, this is as far as the employee taxation is concerned. Now, coming to, I mean, in the recent budget, 2020 budget, there was a small change which was made. As one of our friends had raised a question as to how do we deal with this. So basically, just to give a background of this particular change, what has been said there is, in the case of eligible startups. Let me start with a disclaimer. This provision, basically there has been a relaxation, there has been a deferment which has been provided by this budget. This deferment of taxation is applicable only in the case of eligible startups. So not all startups which get registered will be considered as an eligible startup. To be called as an eligible startup, we should not only be registered, but it should also be recognized by the interministerial committee. So not all startups will get this benefit. No, the employees of not all startups will get this benefit. Only those startups which have been granted the recognition by the interministerial committee, only those employees will get the benefit of deferment.
So it is referred as, one second, it is referred as approved initial recognition by DPIT is what you're referring, or the ATIAC approval by the Income Tax Authority.
Income Tax Authority is what we are talking about, sir.
So here, not the interministerial thing. Interministerial is the DPIIT, that is the initial recognition. After initial recognition, the startup has to apply for the income tax ATIAC approval. So only those who have got both initial recognition and ATIAC approval is considered as eligible startup, because most of the startups, more than 70% of the startups, have not secured the ATIAC approval, and they have only restricted themselves with the initial recognition by DPIIT. And there was some discussions also with finance minister as to say to get the reduction benefit passed on if they have already registered with DPIIT and not with ATIAC. But then that was still a point of discussion, ambiguity. I think the finance minister is still not resolved or given any relaxation as that aspect is what I stand as of today believe. So I think the eligible startup means both ATIAC approval and the DPIIT approval.
Perfectly right, Kaushik sir. So I mean, only about 10 to 20% of the total startups will actually can claim this benefit.
Correct. Yeah. Okay.
Now, what is this benefit? The benefit says, see, what we said is at the time of exercise of the option, the employee in the hand, from an employee's perspective, it would be considered as perquisite, and accordingly, tax ought to be withheld, or the employer has to bear the tax expenditure. So now, at the time of exercise of the option, the employee will not get any cash inflow. So if he is further burdened with this tax outflow, withholding of tax, then it will be it might put off a lot of employees from exercising the option. So in order to provide the relaxation, what the amendment says is, employer is required to deduct the tax at the earliest of one, at the time of sale of shares, at the time of the employee leaving the organization, within 48 months from the date of exercise of the option. If the earliest of these three, within 14 days from these 3 dates, the employer can defer the TDS provisions up to the earliest of these 3 dates. This is the only relaxation which has been provided. Accordingly, changes have been made in section 191, 156 and 140A. So in other words, at the time of exercise of the option by an employee of a recognized startup, there will not be tax implication, there will not be any TDS. It can be deferred till the earliest of those 3 events. So that is the change which has happened.
So as far as the employee is concerned, in the employee's own tax return, how will they show it? Because it is only a deferment.
Very good question, sir. So probably that's the very reason why this change has been made in section 140A. I am also very much curious as to how this year's income tax forms will come out. What I presume is, to that extent, we can actually, although that is a crystallized liability, that liability can be deferred to that year in which the earliest of these 3 events happen. He need not pay any taxes. There will not be any interest which will be charged on this. So that is what I presume.
I agree, but it is part of current year's taxable income, isn't
Yes, sir. It is part of the current year's tax income. Perfectly right.
Only the tax is deferred.
Yes, sir. Perfectly right, sir.
So yeah, we'll have to see how the forms come out.
Yes, sir. Yes, sir. And if we note, then couple of years back, there was a change which was made with respect to section 139(9), where the return will not be considered as defective even if there is a tax liability. So this will, I mean, even that change will further this particular provision.
Okay. Thanks.
Yeah. So that's as far as this. So now, I mean, unfortunately, we could not touch upon other aspects. One is basically, I mean, with respect to angel taxation. I mean, that's a misnomer as far as 56(2)(7)(b) is concerned. So what we were actually debating upon internally was, would angel taxation also be applicable in the case of companies when they allot ESOPs? So basically, if the fair market value at the time of allotment of the shares, if it is more than the exercise price, will that difference be taxed in the hands of the employer under section 5627B is what we need to deliberate upon. We
So
have not.
shouldn't it be the other way around, that if the issue price is more than the fair market price,
value, that is right.
Then there is other taxation as other income.
Yes, there might be taxation, but then logically speaking,
so if the issue price is lower than fair market value, then there should be no problem.
No problem at all. If the exercise price is above the fair market value, would there be any taxation under section 5627B is 5627B is what needs to be looked into. Having said that, logically that situation might not come up. The reason being, why would an employee exercise an option at a price which is above the fair market value? Having said that, fair market value has to be computed by, again, a merchant banker using discounted cash flow method only as far as the income tax is concerned, as far as 5627B is concerned. That's the reason it might be an interesting proposition which we don't know. This is just food for our thought, which we can take it up probably in subsequent sessions. Also, taxation in respect of ESOPs granted to employees of group entities. In one of the earlier sessions, we talked about push down of the cost. What would be the tax implication on push down of the cost is something which we need to deliberate. When we have touched upon this, we need to be mindful of an advanced ruling in the case of Microsoft, whereby it has been said that shares allotted for the parent company would still be considered as an ESOP in the hands of the Indian entity. So this is some push down of the cost is something which we need to deliberate upon. Taxation of ESOP trust. ESOP trust will also be taxed separately under section 164. Provisions 164 has to be taken into consideration. And taxation of restricted stocks and restricted tax units. Unfortunately, we could not touch upon these aspects. We will take it up in the subsequent sessions. So this is as far as ESOP taxations are concerned. I know we have not been able to cover the entire aspects. There are still questions which arise.
One more, maybe one more. Can we assume that as far as sweat equity shares are concerned, their treatment will be almost identical to ESOPs, or does it go through a different regime altogether?
It is perfectly the same, sir. The reason being, the definition of ESOP for the purpose of perquisite includes sweat equity.
Okay.
In fact, I don't think there is a definition of ESOP under the Income Tax Act. It is only the sweat equity which has been mentioned. Oh. Yeah, if I have to look back to the Income Tax Act, I don't think there is a definition for ESOP, if I'm not wrong. I mean, my erudite colleagues can help me out on this. I don't think there is a definition of ESOP under the Income Tax Act. So with this, I conclude my session. I thank with the bottom of my heart all the audience for giving me a patient hearing. I thank Bangalore Valuers Association for providing me a platform.
Can I ask one question?
Sorry, I skipped this. Question answer is something which I skipped. I'm really sorry about that. Yes, madam. Yes, madam. Please go ahead.
Yeah. Can you just briefly tell me what, at the time of exercise, what are the basic things that an employee has to take into consideration just to look into whether it is best, I mean, it is profitable for him to undertake to exercise it or not? What are the things, like there will be withholding tax will be charged to him.
Correct.
And if he wants to transfer or sell it further, then it will be long-term capital gains or short-term capital gains that will be charged to him.
So at that point, at the time of exercising, he has to see, I mean, he also has to consider for what period he will continue to hold on to these assets. So that will determine whether it will be a short-term, long-term, and so on and so forth. As far as the employee is concerned, first of all, he has to see what prospect, what does he think about the merchant banker valuation report which has been provided. Does he really see value in the company? If he sees value, only then he has to exercise the option, is what I would feel.
Being an employee, I think so he will, I mean, if an employee is from sales department, say, or from operational department, I'm not sure he will be very much fine. I mean, he will be having any kind of access to the financial accounts or so. So or merchant banker's report, valuation report?
No, merchant banker valuation report will be available should be available with the employee. Should be available, because without that, how will he compute his perquisite? I mean, how will he come to know about his perquisite valuation? That is something which I think, in my opinion, which employee should be privy to.
At least the information will be communicated by the employer that this is the value that you need to consider for purpose of taxation. The entire report might not be given to him, but employer will have to communicate that this is the value that you need to consider. Right?
I mean, as a part of good corporate governance measure, I would. I mean, I don't know. I mean, I might even share the valuation report.
No, actually, because the valuation report might, particularly in the case of private companies, might contain a lot of financial forecasts and all that data with which the employee might not necessarily be interested in. But is to discharge his tax liability, as far as he knows that number, that should be adequate. Right?
Now, when it comes to the fair market value, I mean, for him to take a decision as to whether he has to exercise or not, it would be his assessment of the fair market value. His assessment for him to make an assessment. Don't you think he will be interested? He has to be interested with the forecast.
No. He has to be told a number.
Okay.
So Uttam, two cases. One where it's a listed company, he knows the value in the market clearly.
Sir.
Unlisted company, what you're saying, yeah, he might want to know, but typically a ESOP program will say that we will give you the fair market value done by a merchant banker, etc. And they will not share the valuation report, because all your forecasts and all that, why would you want to share with every employee?
Okay. Fair enough. I mean, fair enough. That's a question of credibility, I guess. I mean, I completely agree with you, Narendra sir.
Uttam, because of the doctrine of mutuality, ESOP trust will never have to pay any tax, right? Even if it is bound to file its annual returns?
If it is concept of mutuality.
Initially, on the basis of the loan that I get from the company, I buy some shares. So that is in my kitty in the ESOP trust. Subsequently, when the employee takes it, he might take it at a value by paying certain amount. So in this process, the ESOP trust will not be subjected to any kind of capital gains, right?
I mean, this is an uncharted territory for me. I mean, Shravan, I mean, to be honest with you, I need to basically, I need to brush up my income tax skills as far as trusts are concerned.
Okay.
Uttam, just a scenario. In case, as on the date of sale, the share price crashes. Okay.
Okay, sir.
And on the date of exercise, because of market conditions, something, the price is higher.
Okay, sir.
Then logically, it should be allowed, but I don't know whether it is or not. It should be allowed as a capital loss, right?
Definitely. All the other provisions will follow. Yeah. It will be a capital loss. Everything will follow, sir. He will be able to carry forward. He will be able to set it off. Everything will follow. Any other questions? So I presume that, I mean, thanks a lot for everyone for giving me a patient hearing, and I also thank Bangalore Valley Association for providing this platform.
Yeah. Thank you, Uttam.